Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his longest running expert. And frankly, the whole reason we have an expert series, Miss Anna Kelly. Hi, Anna.
Hi, it's always so good to be with you.
Yeah, we've been doing this for like 3 years or so. So it's pretty amazing.
Crazy. Three and a half. Can you believe it?
I can't. I remember interviewing you the day you retired. Remember that?
I do. I do. It seems like just yesterday, but it's been 3 years, 2 months, and a week.
Not that she's counting, folks. Not that she's counting. Oh, that's hilarious. Well, one thing people will know about our story is we've been watching the housing market together for 20 plus years.
Yes.
And as we kind of touched on in one of our videos last week, there's a National Association of Realtors existing home sales came out today. So I want to pull it up. It's just one of the many articles that will be written. I want to go through the report together, or the CNBC article, Diana Olick, break it down, and then talk about why it's exactly what I called, which is kind of fun. So you ready?
I'm ready.
So let's share the screen. So hopefully you can see that now.
I can.
So to set this up, the experts, whatever the experts were, they were expecting existing home sales to come in at a seasonally adjusted 5.4. I said they would come in at 5.1 to 5.2. I said median home price would go up, likely double digits. That was kind of what I set up. So let's get into this. Here we go. So the summary is home sales fell in June 5.4% from May. We'll see later they're actually down like 14% year on year. And as you will see, the slowest sales pace since this month in 2020. And of course, median home price set another record, up 13.4%. That's kind
of what we said, in December, January, that listen, there's going to be a crash in transactions. And the more the Fed raises rates, the more people back out. So transactions doesn't shock me at all that we're down. I'm a little surprised we're not down a little bit more for June, but rates actually did kind of retract a little bit after they went up. So I expect next month, especially if the Fed raises rates today, which they're going to, that number's going to drop quite a bit more.
Yeah, the Fed will raise next Wednesday.
Yes. Oh, next Wednesday. Yes.
Yeah, the 27th. So they break this down into more details here. Again, 14.2% year on year, 5.1. So again, what did I call 5.1 to 5.2? I would say that's a win. 300,000 less than, yeah, well, I just take a guess and sometimes I'm right. It's kind of, that's the beauty of guessing, is sometimes you get to brag and sometimes you're wrong.
That's right.
But let's get down to the real details. Because again, my stance, and has been for 6 months, is the Fed broke housing. That's
yes.
What they just broke the natural order of things. And I want to get down to the transaction levels. This is the most meaningful part, and why I confidently say median home price will not show a negative number this year, because the Fed broke housing. And how can you see that? Here you go. Anna, 100,000 to 250, down 31%.
Yes. And Michael, this is exactly what we said would happen. I remember having this conversation and I said, it's those people that are first-time home buyers, those that can just afford to buy a house instead of renting an apartment. Those are the ones that suddenly can't buy the house. The affordability has gone, way down. And now that interest rates have ticked up, I've seen 25% of transactions in this range fall out of contract nationwide. So this is those people living check to check, trying to buy that first house. Those numbers, I think, are just going to continue to get worse as rates go up. But, those that are above average incomes, we can keep paying and we can keep buying. And we do when we want to.
Yeah. And then when you look at, because again, I'm very clear, median home price, it's a number that really should mean nothing to anybody in their buy box. But it's a number economists like me have been tracking I've been tracking it for 31 years. So.
Yes.
And it will be the number that's reported, like above, right in bold, 416, another record. It's because of the structure that makes up median. If you line up all the homes from cheapest to most expensive, and then you whack 31% of the low end, guess what happens to the median price? It skews. It's a mathematical formula, folks. And stop being angry with me, and because you don't understand how basic math works.
Absolutely. And these are the price range homes, Michael, and in some areas, maybe a little bit higher. where when we talk about the potential for values to come down, the potential to values to come down is in this price range, right? Because if you have a lack of demand is killed, and people are trying to sell their houses in this range. Those are the ones where you might get a bargain, and they're really easily rentable. When you get really expensive houses, they're not going to crash. They might not go up as high, but they're still going to increase year over year, even with interest rates where they are.
Yeah. It's funny. Again, I go back to the statement of Fed broke housing. So let me define that in case it's the first time a viewer heard me say that. So for the last 2 years, pre-interest rate raise, the Fed kept rates too low for at least a year too long. What that happened is it allowed, as you know, 80% of folks to get mortgages, whether it was a purchase or a refi, are now below 4%, 51% below 3.5%, and 18% below 3%. That's what I mean by broke housing, because now as rates have doubled, we actually are killing housing in both directions. What is housing market? Housing is a supply and demand.
Absolutely.
Demand, we have lost 18 million people estimated by Black Knight that could qualify at 3, that don't qualify at 6. That's demand destruction.
Yes.
But more importantly, and for the first time in my 30 years of looking at real estate, the Fed, by keeping rates at too low for 2 years, they've destroyed supply. I actually think the low end is going to have the most transactions, i.e. 31% totally expected that. Because first-time home buyers, but the supply side, Anna, you're not going to sell. Like if you were lucky enough to buy in 20 or 21, you're sitting on 100 grand of equity, 50 grand of equity. You'd want to sell, but then you go to your mortgage broker and go, hey, if I want to trade up, what happens? Oh, my payment doubles.
Absolutely. So people stay put. So when you don't have people selling and you don't have people buying, prices don't really crash.
They just don't move.
They're just going to stay kind of stagnant. In certain areas where people really still can't afford those mortgages, maybe they lose jobs, they're going to have to list, and maybe those prices come down as they become motivated. But I agree with you. I mean, in general, both supply and demand are now broken, thanks to 80%, having really low loans. They can't afford to move up. And I was talking to someone about this recently who's a little older, not old, but a little older, in their 60s. And they're like, you know what, we want to downsize our home, but their mortgage rate is so low that to downsize into a townhouse 1,000 square feet smaller, their mortgage payment would actually be higher, even for a lower priced home, than what they're paying now. So I'm like, stay in your house, modify your garage so you can have a bedroom on the first floor, for now, or build onto it. And don't try to move until rates come back down.
No, this is exactly why, again, I actually think that one of the things I might do in the next year or so is write an economic white paper, which I haven't done in 20 years. Because again, I think the Fed broke housing, and that's exactly why. There's the normal order of life is I buy a first-time home. I'm in it from 5 to 8 years. I trade up, and then another decade, I go, I trade up one more time. And then somewhere late in life, I trade down.
Yes.
That entire process, broken, and for years to come. This is
right. Yeah. I agree with you.
Yeah. So again, Anna, what I think happens from here is this negativity. Again, actually, it's funny. Let me read you some stats. I got some stats from Bill McBride. Shout out to him on Twitter. Again, transaction crash. You're a great city of Houston, right? You're from Houston?
I am.
Down 9.1% transactions. Colorado. States hot. It's top 3 cities based on a report.
Is this month over month or year over year?
Year on year.
Gotcha.
18% transactions. Austin, Texas, 21. Vegas down 24. Maryland down 23. Minnesota down 13. Crash. And again, what am I saying? The next domino to fall is I believe we have started the recession July 1st. And I believe it will be real estate related. We've already seen buildings slow down. That won't help the economy. We are now seeing transaction crash. That's commission and brokerage fees and inspections and painting and movers. Real estate's going to be the blame of the Q3, Q4 recession.
Yeah, the Fed should be the blame of the recession, right? But real estate is typically a leading indicator, to your point. So typically, because real estate makes up so much more of the economy than people realize. It's not just the number of homes that are being bought. People can say, well, so what? I'm not going to buy a house, right? But it's all those people that you just alluded to that are employed through the real estate industry. So if you're not selling homes, and if supply chain issues are still such that cost to do construction is high, then you're laying off people in the mortgage industry, contractors, painters, property management company, employees. You've got a lot of trickle down effect that keeps people employed. And then all of those construction companies and all of their employees and the manufacturers of building supply, they're all really impacted. And so real estate tends to be a leading indicator that you start seeing this happen in real estate, then you're going to see that followed by a lot of layoffs in all of those industries that are impacted. And that's starting to happen already in a lot of different stats that I'm reading. So we're here.
Yeah, we're here. So again, what I'm thinking about the rest of 22 is transactions are going to crash. I think they ultimately could see 30% this year, and then peak to trough could be as bad as 50%. It will be the blame of the recession. As far as median home price, again, given the structural breakage by the Fed, that number does not go negative this year. We could talk about next year. I don't know yet. I don't have an opinion because, Anna, I don't know how high the Fed's going. If the Fed takes the Fed funds to 6%, ARMs are 8.5%, and 30-year money is 10%, I'm going to have a different opinion. Right?
Absolutely.
I just don't.
And that's why, it's important to listen to level-headed people that have been through these kind of things, right? I mean, we haven't seen this level of inflation clearly, but we've been through a downturn. And the reality is we don't know how long supply chain issues overseas are going to impact us. We don't know how high the Fed goes. My guess is that they do what Powell says to not lose all credibility, and they try to get the Fed funds rate to a neutral of 3.5% to 4%, which puts our interest rates probably in the range of 6 to 7. Now, they've said they want to keep us at neutral going forward. Like, we realize this was a mistake to keep rates so low. We probably aren't going back there. Even if we have a deep recession, I don't think we're ever going to see the low rates that we've seen over the last decade, because then they have nowhere to go in the future for recessions. And we have more and more recessions happening than in the past. So my guess is that rates stay higher than where they are now for a long period of time. But if they get significantly higher and they have to pull a Volcker and put rates above inflation in a couple of months or into next year, this could be much, much worse for the entire economy, much, much worse for housing. And the question is, how many people are impacted that have to move, that have those locked in sub-4 mortgages? And if they don't have to move, it's going to peter out. And I expect housing values to be flat across the country because of the lack of demand, unaffordability. I don't see a huge crash in most markets. But depending on what happens in jobs in these certain big cities and where the layoffs are, where people have to move because they can't afford that mortgage payment, those areas, I think you're going to see some pain. And we just have to watch to see how bad.
Yeah, everybody wants to, because everybody picks on me for saying no price decline, because 90% of people say crash is coming in price, and I'm just not that guy.
Right.
So if you want to hear me kind of talk about a price decline in 2023, if we get 30-year mortgages above 9%, we get ARMs above 6, like 5.1, 7.1s above 6, and we get unemployment from 3.6 to 7.2, we can talk about price declines. Until then, flat. I think generally speaking, housing is relatively flat for 5 to 8 years because affordability is a problem.
Right.
But it can be attacked in 3 ways: price, interest rate, and wages. I believe what people aren't seeing is true wage inflation will be sticky, and that will catch up going forward. But it'll take 5 years.
Absolutely. 2 other really quick points before we end this one. One is that investors make up a very large percentage of purchasers over the last 2 years, extreme number, right? And investors can't cash flow once you get to a negative leverage situation. And essentially what that means is if I were to buy $100,000 property and I paid cash and I netted 10,000, that's a 10% cash on cash return, right? If I borrow some of that money and I only put 20% down, my returns are actually going to be higher. Maybe I make a 12% cash on cash or a 20% cash on cash on that down payment. What happens is when you get to a certain interest rate, and with most values of homes, it gets to about 6%. When you're somewhere between 6 and 7%, you end up with what's called negative leverage. And what that means is if I take a mortgage and I'm at 6 or 7% on my 20% down because of the increase in that interest payment, my cash on cash return is less than if I paid cash for the property. And we're in that situation in a lot of markets right now with these DSCR loans that so many of us investors like. And so you're going to see a decrease in the number of investors buying these homes as things gets up, and other than big investors who can pay cash. So I do want to throw that out there. The other real quick thing, there's a weekly update to a report on fortune.com, and it's put out by, I think, the University of Florida, if I'm correct. And they look week after week, month after month at affordability by major market. So what they're looking at is the price to purchase and today compared to the payment, like you've done over the last 52 years or so. But they're also looking at what is the average wage or the median wage in the area that can support a 30% debt payment on their mortgage. And what they're finding, what they do is region by region, they show how unaffordable each market is, how much over that 30% debt to income ratio for a primary home the pricing is of the median home. And what they're finding is certain markets like Phoenix, Arizona, Austin, Texas, Boise, Idaho, Seattle, Washington, San Francisco, California, those markets, and there's other, they're like 60% over what the average wage in that area can afford. So it's those specific markets that I see. If we're going to have any decrease in sales prices and values, it's going to be in those areas where the median home is way higher than what the wages in that area can already afford, even with elevated wages. So look at that chart. It's an amazing chart that kind of shows you the differences, because you and I always say real estate is very local and it's very regional. It's not specific to national. So wherever you're investing, look at if your market is significantly overpriced, or if it's just that people are now paying 30% of their income for a house versus 21% a few years ago. And that makes a big difference as to trying to project where values might go.
Yeah. One of the things I will say is I think it's going to be a race between Boise and Phoenix for the largest price decline for really two different reasons. Boise had a lot of California people come in a very short time. A lot of them are leaving. The economy didn't really support what happened. That's going to be a problem. But Phoenix is really structurally an oddity. It's very different than every other large market, very different than even Vegas, right? I talked to two brokers who deep in the weeds in both markets. And Phoenix, surprisingly, they're getting, like, I talk about the structural difference. We just did it in this video, right? 31% on the low end not showing up. Phoenix is the other way. They're getting more and more on the low end because iBuyers like Open Door are stupid and bad at their job, and they're throwing all this inventory. So I think Phoenix, like, if you want to ask about a market that's going to go negative, Phoenix and Boise, I don't know which one goes more negative. I think Boise probably goes more negative, but total loss of value, Phoenix, because Phoenix is such a much bigger market.
Yeah. And Austin has a real risk of that as well. I love Austin. I'm from that area. I've got family all over. And they've been so priced out. And yes, Tesla's there and Google's there and Amazon's there, but it's very tech heavy. And tech's being hit really hard right now. So most investors over the last year and a half built and bought on speculation of continual appreciation with zero cash flow, almost no deals cash flow, maybe 1%, right?
Yuck.
With inflation, it's nothing. And so many people bought there for appreciation. And if that slows because tech is hit hard in a recession, I think values there could start to really come down a bit. It's a good place to have rental property when people can't afford to own. But in terms of housing, I could see some values starting to come down there as well. So we'll see what happens.
I love that local experience. Anna, where can people find you?
Great. You can find me here every single Wednesday and on my playlist on your channel. You can find me on social media at Anna Kelly, REI Mom, and my website is reimom.com.
Thank you so much.